Imagine this situation. You're working for the Fed, and the interest rate is about 5% currently, but the economy is struggling. We've had some kind of move that's pushed us into recession, and our business cycle is below the trend line. Things are really struggling. Unemployment is starting to really rise. You look to spur the economy. How do you get more people to invest and consume? How do you boost aggregate demand? Well, you could do expansionary monetary policy and lower that interest rate, right? So say the current interest rate is 5%. If you lower the interest rate by expansionary monetary policy, say to 3% or something like that, then what happens? Well, more people will be borrowing funds. Those that have a return on investment above 3% now will borrow funds and invest and consume. Expansionary monetary policy can lower the interest rate and theoretically boost aggregate demand according to activist monetary policy to counter the business cycle and push us forward and forward. But what if people aren't borrowing when you lower this interest rate? The expansionary monetary policy just didn't really do enough. So what if you do it again and you lower the interest rate even further? You lower it to say 0.5%. Now, theoretically, anybody that has a return on investment of greater than 0.5% will borrow, and we will be spurring investment and consumption. But what if that doesn't happen again? What if these expansionary monetary policy issues, just the expansion is not enough? What if we're already at a lower rate, say like 0.5%, and you need to do expansionary monetary policy? What do you do then? Maybe some of this expansionary monetary policy boosted the economy, but what if you're in this situation where you have 0.5% as your current interest rate? Or what if just pushing the interest rate lower isn't really boosting the economy because people don't want to invest or consume no matter how low this interest rate is? When we get really low like this, what do you even do? How do you lower the interest rate much more than this? Real interest rates below zero likely won't spur anything. So we could have a situation where any increase in monetary policy is going to be impotent. This will likely occur once we already have this low rate of interest, but in these situations, well, it's a trap. It's a situation where additional expansionary monetary policy can do nothing to aggregate demand. More precisely, it's a liquidity trap. Increases in the money supply are fully absorbed by excess demand for money or liquidity. Investors hoard the increased money instead of spending it because the opportunity of holding cash, those foregone earnings from interest, is zero when the interest rate is zero. There's no reason not to. Liquidity traps are talked about when changes in the money supply fail to translate into changes in the price level and or interest rates that are close to zero. So if pumping money into the economy doesn't change the price level, or we have a situation where those interest rates are close to zero, a lot of times that's when we talk about liquidity traps. It's a situation where lower interest rates don't spur consumption or investment. A liquidity trap could be defined as a situation in which conventional monetary policy has become impotent, often because nominal interest rates are at or near zero. So therefore, injecting the monetary base into the economy has no effect because the monetary base is seen as having just as good of a return on investment. John Maynard Keynes described this in his general theory. After the rate of interest has fallen to a certain level, liquidity preference may become virtually absolute in the sense that almost everyone prefers cash to holding a debt which yields so low a rate of interest. A liquidity trap can be caused by people hoarding cash because they expect some kind of adverse event, such as deflation, insufficient aggregate demand, or war. We'd rather hold cash than invest or make big purchases. In this pessimistic situation, monetary policy could have limited to no impact. More money in the hands of banks and people just means more money that banks are sitting on and more money that people are stuffing under their mattresses. The signature characteristics of a liquidity trap can be described as follows. That 1, short-term interest rates are near zero. 2, people are trying to hoard money. And 3, investment doesn't rise in response to the lower interest rates. The idea of a liquidity trap may help us make more sense out of the original orthodox Keynesians that were more fiscal policy oriented and then moved closer towards monetary policy after World War II. We can look at the interest rates during the Great Depression and during kind of these different eras here. Once we get to the 60s, the interest rates are going to be a little bit higher, whereas during the Great Depression, interest rates were actually quite low. So the liquidity trap was more of a concern around the Great Depression. And when fiscal policy was more popular during this time period, that kind of makes sense. Once we hit the 50s and 60s, monetary policy starts to go on the rise, in part because the liquidity trap is less relevant. During the Great Depression, people are hoarding cash because they're expecting some kind of adverse event. And so lowering that interest rate wouldn't really spur anything anyway. And in addition, our interest rates are already really, really low. Once we hit the 60s or so, the interest rates are starting to pop back up. We're not expecting that adverse event as much. And so we can start to think of the world as not being the situation where we absolutely just can't do monetary policy, right? The Great Depression era might seem like a situation where the liquidity trap is a little bit more relevant. Even if we're not necessarily in one, we're closer to one, right? US interest rates had been quite low during this time period. Theoretically, dropping them would do not quite as much, do very little to spur investment, and thus we get more of the kind of Keynesian view of the loanable funds market where monetary policy, especially drops in the interest rate, don't really spur additional investment. If we are in a Keynesian world, and if we are in a liquidity trap, there may be only one way out. If we're in a liquidity trap and monetary policy fails, some Keynesian activist, monetary policy or fiscal policy advocates would call for, hey, use monetary policy first as the first line of defense to counter the business cycle. But if monetary policy fails, if we have a situation like a liquidity trap, then perhaps try fiscal policy to boost aggregate demand. Not all Keynesians work this way, but this is kind of a modern standard that most people kind of have moved away from the fiscal policy camp and into the Keynesian activist monetary policy camp, right? And they view it as, well, let's try monetary policy first. But then some of those people say, well, if monetary policy is in one of these sticky situations, like a liquidity trap, then perhaps we could use fiscal policy to try and boost aggregate demand as like a last line of defense.